In this section, we're going to discuss about the speculation and hedging terms. What are these terms, and how does the futures and forwards market basically get used for these purposes, right? So the first primary objective is the definition of these terms. The terms called as hedging and speculation. Right, there's another one called arbitrage, which will come in a subsequent section, but at this point of time we're more concerned about hedging and speculation. So let's first understand what these terms mean, and then try and identify how do we use these in the context of derivatives and specifically futures and forwards, right? So hedging is a process to reduce the risk of adverse price movements in an asset. Right, so essentially, if you're in a business where price movements of an asset could have an adverse impact on the business, the process of trying to reduce the risk or de-risking is known as hedging. The name comes after creation of a hedge around a farm, right? So if you have a farm and you have basically created a hedge around it, that's to protect the farm effectively. That's where the term hedging comes from. So you're trying to protect your business from adverse price movements of any asset. That could be your input, that could be your output, whatever that asset be, whatever that asset's price be. You don't want volatility in that asset's price to create a problem in terms of your business plans. That's what hedging helps you with. Speculation, on the other hand, is actually just betting on directional moves in an asset's price. So if person A believes that Infosys will go up, or when I say Infosys will go up, that means the stock price of Infosys will go up. Person B believes that stock price of Reliance Industries will go down, right? These are directional bets. Some person might believe that the USD INR will go towards 75. This is a directional bet. You're not really trying to de-risk yourself. You're basically placing a bet on a particular asset's price going in a particular direction. This is known as speculation, right? Now, futures and forwards are commonly used for this since they have an inherent characteristic. They have a similarity to the placing of bets, and that's what we are effectively trying to do when we are doing a speculative bet, or if we are putting in a hedging kind of a scenario as well. Now let's try and understand how does a future get used for something like a hedging kind of a process, right? Now let's see, as discussed earlier, futures and forwards can be used for hedging exposure of companies to critical asset prices, right? Take the case of an airline company, like let's say Indigo Airlines in India, right? These guys, one of their key raw material is aviation turbine fuel, right, which is basically a kind of jet kerosene. This is called as ATF. It's a variant of kerosene which is called as jet kerosene, and this is the prices are derived from global oil prices, or what is called as global crude oil prices. Now these are prices which are moving up, which are moving down. If we want to have a sense of crude oil prices, these prices used to be there. So they are in terms of US dollar per barrel. A barrel is a certain equivalent in terms of number of kgs or liters. Essentially, $40 per barrel is what they want to kind of fix the price at. The prices last year were around $100 a barrel. Now they are around $30, $35, $40 a barrel, in that range at this point of time. Now, they want to fix this price for themselves because that's a raw material and that's a huge cost for them, right? One of the biggest cost in the airline industry, is the fuel cost, right? Now you want to kind of hedge the fuel cost, right? Because if for some reason this US dollar 40 goes up to US dollar 80, that basically doubles your cost, and you don't want that to happen because that could be extremely detrimental to your margins, to your profitability, to your business, right? So that's the risk. What is the key risk? The risk is that prices are derived from global crude oil prices, and these could go up, and that will increase the input cost, and that will reduce the profits of the company. So what do? They find a futures market where futures on crude oil prices are trading. Now, one thing they could do is basically they could go and actually just, let's say they want to buy crude next year, they could just get into a future contract saying that you can buy crude oil at a price of US dollar 40 next year, right? So they could take delivery of that crude as well. So that's what we had discussed in the forwards argument. A crude oil producer may believe at this point of time there could be a crude oil producer who is worried that prices may fall. Prices have been falling extremely fast. So there's a producer who's worried that prices may fall. There's an airline company who's worried that prices may kind of go up. So a producer and an airline company can basically get into a direct contract with each other. That's one way that can happen. The other way is they go and buy a future contract that says you can buy crude oil at prices. In other words, crude oil at a price of USD 40 next year. In other words, they are making a bet that oil prices will be higher next year in the markets by then. Only then will they profit here on this particular bet. However, here the the purpose is not to benefit from the price moves, but to de-risk against adverse moves, right? So hedging is a double-edged sword. We will try and understand how does this work, right? So what has the company done today? They enter into a contract which says buy crude oil at 40 next year. In other words, they are saying crude oil will be greater than 40 the next year. That's their bet, right? That's when they would want to buy at 40, right? Now let's see what happens if the prices go to 30 per barrel, and if the prices go to more than 40, which is let's say 55 per barrel. So let's first take case 2, which is price is at USD 55, right? Now in this case, actual raw material purchase will happen at USD 55, but bet payoff, remember they were saying the prices will go above 40, bet payoff is USD 15, so net amount that they pay is USD 40. Net payment is USD 40, correct? They make 15 on the bet and they lose 55 on the actual raw material. If the price on the other hand is USD 30, US dollar 30, then the raw material purchase happens at USD 30. The bet payoff, now this is a loss. That's a loss of USD 10. And let's actually put signs to this. So this is negative, this is positive, this is negative, this is negative, this is negative, which will mean that you will have USD 40 negative again. So regardless of what happens to the crude oil price, because you have put a bet on the crude oil price, you will lose money on one direction, right? And you will win money in one direction, but your net payment your net payment is now fixed at USD 40, which is essentially in a way saying that you have, regardless of the condition, de-risked yourself against adverse price moves, right? Now, the interesting part here is that in the first case, in the second case, in the first case they were losing money because the price went to 55, but in the second case, if there was no hedge, they would have gained because the raw material cost would have been 30 instead of 40, right? Because they entered into a contract at 40, their eventual cost became 40. Otherwise, they would have benefited at 30, right? Now, that's where the purpose of hedging has to become important, is that remember that while hedging protects you against adverse outcomes, it also removes the chance of the company making higher profits, if the prices of crude fall, the prices of crude oil fall. I'm just using the term crude for crude oil. But the chance of making a profit there also goes away, right? This is a bet that the company has to make, since the idea is to de-risk and not to make money out of moves in crude oil prices. As a business will say, I do not want volatility. As long as there is no volatility, I can plan my business. So as long as the price is fixed at 40, I'm good with it. I will plan my business. My worry comes is if the price is 30 in 1 year and 50 in 1 year, then 1 year I make a lot of profit, another year I don't make as much profit. If it is 40 all the while, then I can plan everything else around that 40 level, right? So it's important for us to understand the purpose of hedging. The purpose of hedging is to ensure that there is no volatility. Now, there are times when you will make money out of this entire hedge. There are times when you will lose money out of this hedge. For example, in this case, here the hedge was profitable. Here it was loss making, right? So that's the nature of a hedge, that while it protects you on the downside, it also takes away any potential upside that could benefit out of a hedge. And that's the call a company has to make in terms of how big a risk do they face because of that volatility, and how much of the risk do they face. A lot of the companies put these kind of bets in the case of hedging. So for example, a lot of the exporters in India hedge against the USD INR value, right? Remember, if you sell something worth $100, what you make in India if the price is 65 is 6,500, but if the price falls to 60, you end up making 6,000 only. So there is a risk here, and you may want to mitigate this risk by the usage of some sort of a forward or a future contract on the currency. You may want to kind of hedge the currency exposure at a particular value. That essentially is the premise of hedging. Now in that case, if you hedge this at 65, it will always remain 65. If it goes to 60, you'll win the bet and you'll make 500 on that bet. If it goes to 70, you will lose the bet and you will lose 500 there. But your net payoff will always become 6,500 because you have fixed the price of USD INR at 65, right? What you are ensuring is that there is no volatility, and if there is no volatility, it's easier to plan the business. That's what you're trying to do, right? That's the use of forwards and futures in hedging essentially. Let's discuss very quickly what is speculation. Now, someone might just be trying to make money, on the bet that crude prices will go up or will go down. Now, this person is not really hedging or de-risking a business. You're trying to make money based on your viewpoint, right? This is essentially the bet. You're just going and betting that prices of crude oil will be greater than 40 next year. There is no underlying business. This could be a bank who's betting on this price. This could be a trader who's betting on this price. So whenever you are randomly, I shouldn't say randomly, but whenever you're only betting on a directional move in the price without any element of de-risking involved there, right? This is essentially what is called as speculation. Now, speculation is a dangerous game because you are essentially betting on one-sided move of a price of an asset. The price could go up, the price could go down, but your bet is that it is going to go in that direction. So you can win some and you can lose some depending on what happens to the underlying price, right? This is essentially a simple bet on something going up or something going down. That's what speculation is. Again, a huge chunk of the global futures and forwards market is purely speculation. Large part of the trade in futures, for example, is essentially just pure speculation. In fact, there was a lot of hue and cry because of the oil prices moving so volatile in such a volatile fashion that a large chunk of the market for crude oil is nothing but speculation. No one really, or very few people actually hedge in that market. Most people are just purely betting on directional moves in crude oil prices, and that's where speculation becomes dangerous as a game because the moves could be extremely fast and there's no underlying business that you're trying to protect, right? So that's hedging and speculation, and how do you use your instruments of forwards and futures in order to kind of achieve these objectives. Another principle that is important for us is to actually understand how does the pricing of futures work, which is the concept of arbitrage, which we will bring in the context in our next discussion, next section, next video. Thank you.